Today's topic is about African traders versus quant firms, unpacking the secret activities of quantitative trading firms. The 10 a.m. anomaly. Are African traders following Wall Street's algorithm, or are African traders actually, do they stand a chance? Because in Wall Street, it's a zero-sum game. In order for someone to win, somebody has to lose. We can't all win. So what happens is, if you place a trade, or you place a short, or you place a long, the aim is you are trying to predict the market, either using algorithms or using intuition or secret information, right? And the only reason people get into the market is because of they believe they can make profit out of their money. What is the 10 a.m. anomaly? Since late 2025, traders worldwide, especially in Africa, have observed a recurring price dip affecting Bitcoin, often wiping out a lot of individual small traders' accounts. So the central question today is, are local traders unknowingly providing liquidity for larger international firms? So who are the players? Let's meet the quant firms, right? Like the local traders, they are not competing against individuals. They are competing against algorithms, big players. And within the algorithms, they are ignoring the invisible hand rule. So in finance, one of the common language you would hear is optimism and pessimism of the market, right? If there's a war, the market gets pessimistic because of they're scared of what would happen. But if they elect a new leader and the leader is campaigned about hope, growth, then there is optimism. People believe the economy would be better. So the key point is, when Chicago firms or New York firm in Wall Street, they use the Rule 200 regulation of short to hide their short position. Traders in Ethiopia, in Ghana, see the sell wall, but they don't get to see the short wall. The key is they are allowed, according to this rule, to show their long position, but they are not allowed to show their short position. So in late February 2026, a company filed a lawsuit against a quant firm, and their claim was inefficiency creation. In summary, they allege that a particular quant firm created an inefficiency in the market with their algorithm, and many traders rely on margins and leverage to amplify their small capital. For example, in Nigeria, 80% of the traders in the crypto market within $100 and $10,000. And most of the traders, because of how small their capital is, they have to rely on margins and leverages to trade. And once the price threshold is hit, right? So they get the margin or they get the leverage to trade, and the firm they are loaning from, either Binance or Bybit, automatically sets a sell button. And what that means is, if the price drops below a certain amount, with or without the trader's permission, the app is going to sell their position. And this has wiped a lot of small traders out of the market. And the allegation in the lawsuit claims that this quant firm knew about what it was doing. This quant firm in question has been banned from trading in India because of a similar position. And allegedly, a lot of players in this quant firm have a lot to do with the FTX scandal and the 2022 $40 billion crypto loss that happened. And when we talk about 2022 $40 billion loss, we're talking about an amount bigger than Zimbabwe, Senegal, Sudan, and Zambia combined. So we're not talking small money here. We're talking a lot of money. We're talking about life-changing money. So who are these traders? They are called the prop firms. Prop firms usually work with high-frequency trading and market making, right? So what it means is, an investment firm or a hedge fund is trying to create an ETF, or they create an ETF. They need a market maker to pump money to have that trade. And on the other hand, in their high frequency trading, what they do with this strategy is they put on positions and they pull out of their position. They try to make money bit by bit. And at the end of the day, they close their account with zero position. They're only trying to make a certain amount of profit at a particular day. Other traders like hedge funds and banking divisions, they are not normally affected with this high frequency trading. Hedge funds usually use arbitrage, statistically arbitrage trading and trends and following of trends. While the bank division, they execute and manage risks for their clients. They're not really the aggressive type of traders. And all their positions, both the hedge funds and the bank divisions, are shown, but not so for the prop firms. The prop firms, on the other hand, because of they use their own money, they are allowed to show their long position, but they are not allowed to show their short positions. So prop firm, their primary strategy, buy low, sell high, act as a pumping or financial market for some other hedge funds. And the goal is to close their day with a zero net position after making tiny profits from all of their trading. So the African context. Sub-Saharan Africa is the third fastest growing crypto region globally. 55% of their youths are active in it. Over 8% of their value transaction is between small traders under 10,000 US dollars. Because of countries like Nigeria, South Sudan that have seen dramatic depreciation in their local currency, a lot of their youths hedge against this depreciation with crypto. So what happened after the lawsuit was filed in February 23rd, 2026? The 10 a.m. drop reportedly paused or stopped. It just disappeared. So it's really hard for one to say, is that a smoking gun or is it all coincidence? We don't know. Time will tell as litigation goes on within this. But regulators in countries like China and India, the India SEBI has created regulations to stop actions like this. And China totally banned every form of crypto trading within their country. I'm not for the ban of the crypto trading, but I'm for regulators within the African region to think about their small traders and find a way to help them, because these traders are competing against computers, algorithms. The real question is whether manipulation occurred at 10 a.m. or whether this is ethical and legal or unethical and simultaneously legal. Recognizing the power imbalance is vital to trading, or is vital in terms of representation and participation in the market. And for the traders in Africa, they need to understand what is visible and what is hidden or concealed within the market that they're trading in.